The HODL Factory had another impressive win against the S&P 500 in the third quarter of 2024. Our stocks outperformed VU by 5.8% in the quarter, and they extended their year-to-date lead to a cool 10%. Hutch and I recently held our quarterly meeting to assess our portfolio for any necessary changes. We did end up dropping what is arguably our most popular stock in favor of a rather boring position. In this video, we'll briefly recap what the HODL Factory is, its results since inception, and what took place in this recent meeting. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please electrocute that like button, subscribe if you haven't already, and drop me a comment down below with anything that comes to mind. Quick shout out to my Seeking Alpha affiliate link in the description below if you or a friend wants to try Seeking Alpha Premium, which I love, for free for 7 days. And if you like it, you can save a chunk of money on your first full year. All right, you know what time it is. Let's grow. HODL Factory Origins. I'll be releasing a quarterly update video about the HODL Factory, so I'll try to keep this section short and sweet. My best friend and I started the HODL Factory on 4/20/2023. Check out the first video that I dropped if you want more background about Hutch and me. I'll link it down in the description below if you missed it the first time around. The short version is that we both love investing, and we were both seeking a way to beat the index without using our gut to call all the shots. And we had both done very well with our hand-picked stocks over the years, but we wanted something that was both repeatable and sustainable for the long run. After many chats over the years, the HODL Factory was born. Let's get into it. Quarter 3 2024 update. We left our formula alone for the most part this quarter, outside of a very small change to our scoring modifiers in the spreadsheet. The first thing we do each quarter is we run the screener out there in Seeking Alpha. We have 10 key metric hurdles that each company must clear to make its way to the scoring spreadsheet. It remains an evolving process that's being ironed out each and every quarter. 140 companies made it to the scoring spreadsheet in this quarter's update, and that was 9 fewer than the quarter before. The scoring system in Excel assesses 12 categories, each with a custom scoring modifier based on the importance of the metric. We currently hold 25 individual stocks within the HODL Factory, and the turnover was greatly reduced this quarter with the one major change that did come out of our meeting. We decided to officially have a reconstitution on the third Friday of every March. On the other 3 quarterly updates throughout the year, in June, September, and December, we'll only drop companies if they miss the screener altogether. There are a few other small rules that we have baked into this thing, and I won't waste your time with those, but we can safely expect most of the turnover every March. It's time to spill the beans. We dropped Avgo this quarter. I know, we like it too. Our guts didn't love this move. But Broadcom straight up missed the screener, period. It was a top 10 scoring company on each quarter that we had done in the HODL Factor's history before this quarter. Someday I'll fully disclose all the details of the spreadsheets and the specific methodology, and it's pretty complicated. I think you guys will really like the system. And you know, I wasn't mad at SCHD like everyone else was when it dropped Avgo. So we're cool, right? The boring company that replaced Avgo in the HODL Factory was none other than DVN, Devon Energy Corporation. And I feel pretty good about this one moving forward. And speaking of moving forward, let's check out the current holdings and the total performance in the next section. The results. The HODL Factory is still a brand new baby in the investing world. It's only been around for 17 months at this point. It has done incredibly well in that short amount of time. We always remain skeptical, but it's not like we're mad about beating the market so far. I did mention the turnover in this section of the video a quarter ago when I dropped my first HODL Factory video. We have had a high turnover figure in prior quarters due to tweaking the screener and the spreadsheet formula. This quarter was more stable, and I expect that to continue moving forward. And the last thing I'll say before jumping over my screen, Hutch and I haven't yet dumped a whole bunch of our personal money into the HODL Factory, and I recommend the same for you. We are taking a wait and see approach overall. I always like to put that out there. With that all out of the way, let's jump over to the juicy returns. We'll start out here on M1 Finance, and you can see I've pulled up the HODL Factory, and I'm on the portfolio tab here. I'm a little more zoomed out than usual, so you might be able to see a little more. Now I started on the All tab. Now it looks like I'll need to scroll a little. So on the entire time we started since 4/20/2023, if I scroll down just a touch, there you go, we can see here. You can see that the HODL Factory has 69.28% gains lifetime. And again, that's a money weighted return. So it reflects how real decisions have panned out, including all sold positions. This is total returns, all things considered, since inception. And the market in that time, VU, has gone up 41.95%. So we're looking pretty good there. And when I come out here and we'll zoom it out to year to date, we're up 30% to the market's 20. So it's been a very lucrative year in the market and we've outperformed that, which is nice to see. The last quarter, Hutch and I are up 10.67% to the market's 4.91. So we had one heck of a quarter in between updates. We're really happy to see that. And now, unlike the typical high-level portfolio update videos that I make, I'm going to actually dive into the holdings here. And we'll see more of this on a spreadsheet later as well. I put it back to all, and I'm going to sort, it looks like it already is. Yes, I'm going to sort by gain. So this is just by total returns by position for the full duration. And I should specify, I'm not going to read off every single ticker. And I will say the higher return doesn't mean it's a better company. I have typically held the highest returns a lot longer than the lowest ones. And we'll get into that here pretty soon. But I'm just going to scroll down the list and I'll let you read them if you would like. You know, I'm not going to read off every single company. I might highlight a few of them, but you can see we have some pretty good total return gains. This does include dividends and everything. See, Microsoft here is at 37%. I've had it since the beginning though, so some of these have outperformed Microsoft by quite a bit, but we all love Microsoft. Let's be honest. I was going to kind of scroll down. We'll dive deeper into this data in the spreadsheet, but I wanted to give a chance for you if you want to pause the video and just see each position. We're getting towards the bottom, and again, we're going to see some losses or some slight gains. Like MasterCard hasn't been around that long, although it has struggled, I will say. Same with Visa. It's had some really nasty news lately if you guys have been paying attention with some legal things, so it's down total return. But you know, Devon Energy I've had for a couple days as of this video, so I don't put a lot of stock into it being down almost 3%. And yeah, EOG Resources, like a lot of these I have not held very long. So we'll see how things play out in the long run. That was just a quick little snapshot of all my companies and how they've done since I've held them. Now we're going to jump over to a more comprehensive spreadsheet to see some high-level key metrics. We'll start here with the HODL Factory stats spreadsheet, and this one's out on the server for anyone to see. Link in the description below for all my free spreadsheets and Google Sheets. So every week I update this and you can keep track if you would like to. What I do is I pull in a bunch of stats, and these aren't necessarily the scoring metrics or the screening ones. Some of them are, but not the majority, but just stuff I find important for holdings to succeed on ultimately. And it looks like I have to scroll this over a little, but it doesn't really matter. The last column over here is PE ratio, but everything sums up to here anyway. I guess what we could do here is, this is just pulling in a bunch of data from Seeking Alpha with XLOOKUPs, and then these are all like some products to get the averages. And it does look at my actual holdings, like this is the value at the time. This is a little older than the one we saw perhaps. And then it sums up some stats, and I'm actually just going to go to the important page here. So this is just some key metrics of the market, the S&P 500 against the HODL Factory, and then a percentage lead or loss. So we'll just dive down some of these categories here. Blue has to do with dividends, but you can see that the 3-year dividend growth rate for the HODL Factory is 20.1%. compared to VU's 7.8%. So we're 159% better on that. And then on the 5-year dividend growth rate, the HODL Factory is 18.8% to the market's 4.4. So we're up over 3 times on that one. Now you can see yield, we're at 1.08%. So we focus more on growth, where the market's at 1.26. So we do get out yielded by 15%. I don't overly care about yield when it comes to factor investing because it's really just a vanity metric, except for the day you buy a company. As price goes up and the dividend per share goes up together, the yield stays the same, or as everyone knows, price can drop and yield goes down. So it doesn't really matter. This is much more important in my opinion, along with the returns, because ultimately they create the results, not the yield. But it's something to watch. And with the HODL Factory, our goal is to double the yield via the rule of 72 every 4 years, and we do just that. In the last 5 years, this yield on cost doubles every 4 years. So if you held this portfolio for 4 years, you'd be at a 2%. 4 more, you'd be at a 4%. 4 more, you'd be at 8%, etc. And then the payout ratio, we want to see a low figure for dividend safety. The HODL Factory has a weighted average 21% payout ratio to VU's 35%. So it's good to be lower. We're 40% lower. And then on the total returns, this is the 3-year, 5-year, and 10-year total return. Here's what the HODL Factory has done over that time, and here's what VU has done. So in the 3-year, we're up 195%. In the 5-year, we're up 137%. In the 10-year, 183. And again, we haven't held these this whole duration, just to be crystal clear, but it's good to see what that mix has done. Net income, this is a current metric, is 26.6% to the market's 11.5%. So it's up by over 100% there. And I think that's an extremely important metric for long-term factor winning. And then free cash flow margin, 17.7 to 14.5, fairly close, up 22%. And then here's the numbers we already went over. You can just see them in spreadsheet form. And then the lead, 49% year to date. On the 1 year, 16%, that's interesting. And then on all, we're up 65% lifetime. And it was last updated on 9/25. So we're here on Wednesday and the market is closed. That's when I'm recording all this. This last spreadsheet is not available to the public. This is one of many, many tabs on the HODL Factory spreadsheet that ultimately has the screener dropped into it and runs through a bunch of scoring algorithms. But this is the snapshot page, I guess you could call it. And this is where Hutch and I will put some focus on. Like, we replaced Abgo with Devon Energy this quarter. And you can see that the 5-year dividend CAGR, and this number could be slightly different than the one I just showed because it's, this happened when we did the screener. And this is forward yield, so it is higher. The other spreadsheet conservatively uses trailing 12-month yield, whereas this is forward yield. But anyway, we like to look at how changing these, and this is all linked real time, so you can put in any ticker you want that made the screener, and it'll update the weighted stats here. And this is just how we get an idea of the snapshot of what our health is looking like. And these are just stats that we think are important. And PE I never covered on the last one. 24.1 at the time we ran the screener. Actually, we're going to alt tab over real quick. The PE here was 23.9, which is lower than VU. So I like that. I might need to add that to this scorecard, actually. I never thought of that. But then hopping back over, and why I really want to show this one is the sector breakdown. 2 or 3 quarters ago, we changed this because we used to be very high naturally in financials and technology with the way we screened, and as well as industrials. But what we've done is we've sector capped at 20%. So I have a scoring tab down here that I'm not going to show, and it goes through a bunch of stuff, and then it ultimately spits out the top 25 companies, but then I have to trim it based on sector capping. So this is just like sort of the high level, and then these are copy pasted to a few other tabs, but this is a good snapshot look at how we're doing. And I mean, you can't find ETFs like this, frankly. We'll see how it does in the future, but we really like our balance between growth, yield, net income, my favorite stat, and then the total returns, and PE ratio. This is just some of the heavy hitters where if any of these were way out of whack, I would be uncomfortable. There are also many other important metrics to consider in this stuff, but these are like must-have non-negotiable for Hutch and I. Now let's get to the part that will make you do a double take. HODL Factory versus SPY with a backtest. Okay, hold on a minute here. Yes, my mic is on, my camera's on. Okay, this thing's on. I had trouble with this part last time. People dropped a lot of comments about this backtest, even with a very clear disclaimer. So let's run this back. Major disclaimer. I have not owned all these companies for the full duration of this backtest that we're about to see. This is strictly a what-if scenario to see how the current mix has fared over the last 15.5 years. Our screener would likely not have picked up many of these companies in the past, and I'm not claiming that this thing will do this well in the future. Okay, I hope everyone tuned in for that this time. Now, let's go check out this crazy backtest. Boy, oh boy, I have not had good luck with these recordings lately. I just lost a big chunk. So let me start over here. We're at our portfolio visualizer, and we're going to pull as much data as we can. So for our settings, we have 1985 to 2024. and we won't actually be able to pull that much. We'll get there. Include year to date, yes. And we're starting with $10,000 in each portfolio, contributing $1,000 per month. And then reinvest dividends is yes, and display income is yes. And when we come up to the portfolio assets, you can see the HODL Factory is portfolio 1, and they're all there, I promise. We'll see that in a minute. And then portfolio 2, we're going to use SPY to be able to pull more data than VU because it's older. So when we scroll way down here, and you can see I put in the new one and I removed ABGO and we're good to go. I'm gonna hit Analyze Portfolios. We're able to pull from 1/1/2009 through 9/24/2024. And so that's 15 years and change of data. It's a nice chunk. And as we usually do, we'll pop down to the portfolio summary. So you start at $10,000 with both of them. And with the $1,000 a month, the HODL Factory would end at 1.9 million to SPY's 700,000. Again, we didn't hold these all along. This is just to see how that mix does over time together. And what I do care about though is the worst year. And we'll get into the year by year, but we're down 10% in the worst year compared to the market's 18. Hutch and I value stable floors, which is why we look for a lot of that dividend growth and low payout ratios in our holdings. And then our Sharp and Sortino are pretty high risk adjusted returns. Now this is the tab we'll spend the most time on because the overall returns are great, but hindsight's 2020, all the things we've talked about. But you can see here, blue is the HODL Factory, green is SPY, and I immediately look, we only have since 2009, so that's unfortunate, but I immediately look down below. So the HODL Factory lost more money in 2018, that's not great, but it actually made money in a struggling 2022. So I do like that about it. The floor seems pretty good because these companies, spoiler alert, have great moats, and they also have positive current net income and net income growth trends. Will there be some messy years in the future? Yeah, but we're hoping that our floor stays pretty stable during that time. We'll cover this quickly. The annualized returns, they don't care about contributions. For the full duration, it's about 24.2% to 14.3. And then over the last 10 years, it's up 23.5 to the market's impressive nearly 13. And this one's wild here. In the last 5 years, just the market alone, this averages 10% over the last 100 years. In the last 5 years, we've been pretty blessed here. We're almost up 16% with just SPY. And the HODL Factory would be up about 32. In the last 3 years, HODL Factory 27% per year to the market's 9. And then just last year, they've both been tremendous at 35.6 to 26.9. And this one we actually have mostly held HODL Factory, as you guys know. But I like to show this one. This is that dividend growth. You can see in 2009, we would have had a measly $306 of dividends compared to 407. And I won't read them all up, but I'll let you use your eyeballs. Here's what that 18 to 20% growth does over time. Now, it's not necessarily fluky. You can see it's relatively stable, but now in 2022, you would have had $21,500 compared to $7,500. This compound stuff is exponential, people. And in 2023, 18.2, actually a little lower, you can see there, to the market's 8,100. And then so far this year, it's hard to judge because some have paid and some haven't, whereas an ETF does it all at once. But the growth really matters over time. And that's why the low yield doesn't phase Hutch and I. And here's the HODL Factory sectors. I know we already took a look at this, but you can see that nothing gets over 20%, just like my spreadsheet specified. So I'm proving to you guys that I'm actually not just making this stuff up a little bit. But what I really want here is SPY. So you can see the current PE ratio of the S&P 500 is just under 27. Whereas we shared before, we're around 24 at the HODL Factory. I like having that value edge. I don't just want to stack a bunch of tech companies. So that's one thing I also like about the HODL Factory. And then the market, as we know, is a little high on technology at 32%. Man, and you guys thought Jay Powell could print money. Where are we going next? The future. We have enjoyed the short journey of running the HODL Factory. And I don't know if beating the market is sustainable long term, but at the same time, I'm excited to see where we can take this thing. Win or lose with the HODL Factory, I'll be here for you for many years to come. And speaking of amazing people that aren't going anywhere, we had 2 new channel members this week. Huge shout out to Blaine and Chris for joining the channel membership this week. I really appreciate the support, and I hope you enjoy the perks of being a member. And of course, thank you to all you that have been here all along. Check out one of these 2 videos to continue down your path towards your version of financial freedom. Thanks for watching, and I will see you here next Sunday. Peace.